Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.
Hello and welcome back to Kitco Mining with me, Paul Harris, here at the 2025 Mines and Money Conference in Miami, Florida. Today we're talking about investing in the junior mining space, and I have great pleasure to be joined by Matt Geiger, Managing Partner at MJG Capital, to join me in this. Matt, welcome back to Kitco.
Thanks, Paul. It's great to be here with you.
It's a wonderful time in the metals space. I think gold's at all-time high prices. Copper's really moving higher as well. But before we get into the company specific, let's start with the sort of big picture aspects and your thoughts on where we are in the sort of the respective copper gold cycles right now.
Yeah, I think it's fair to say we're probably at the end of the beginning. I think we're still relatively early in this metal cycle. We have not seen massive increase in capital expenditures, new greenfield projects going on. A lot of the M&A we're seeing is existing producing assets just being consolidated under a bigger banner. Additionally, we've yet to see generalists really move into the space whatsoever. So I still think we're early-ish, but obviously the moves that we've seen in gold, particularly last year, up 27% over the course of the year. That's the strongest annual performance for the metal, dating all the way back to 2010. That has to, raise eyebrows. With that said, the metal equities have largely been left behind. We're seeing some reaction to start the year, especially amongst the larger gold producers. Some of the names are up 30, 40% on the year, so it's exciting to see some price response. But 2024, at least if you're invested on the metals equity side of things, is actually an extremely painful year, especially if you're more focused on the junior end of the spectrum like the MJG Capital Fund is. Juniors were neglected for the vast majority of the year. There was a window of about 4 to 5 weeks from late September 2024, really up to the day of Newmont's massive earnings miss. That date is ingrained in my memory, Thursday, October 2024. Totally threw cold water on the space, and then really Chinese water torture through the rest of the end of the year. So I think there's still significant run to move for the broader metals equities, and we may be in the early stages of a response here. The big question is, does the love that we've seen to start 2025 last throughout PDAC or not?
Well, Newmont reported its full year 2024 results today, and they were very impressive. We'll get to those in a moment. But first, let's look at some of the factors that are driving metals prices and the mining sector at the moment. I think it'd be fair to say that there's some sort of factors here that are working away now that perhaps weren't there a year or two ago.
Sure. Yeah, I mean, on the gold front, I would actually argue it goes back to Biden's decision to take Russia out of the SWIFT banking system. I think that sent chills down the spines of central banks globally that aren't necessarily adversaries of the United States, but maybe aren't our closest allies either, and concerns that if they get on the wrong side of a particular issue, that we could do the same to them. So I think the primary catalyst, and there's a lot of different variables that have led to this run that we've seen in gold, has been central bank buying through and through. There has also been a retail response, primarily in the Eastern world. We are seeing a little bit of institutional buying pick up, but I still think there's significant room for gold to run, just because we haven't seen Western institutions throw their hats into the ring, let alone Western retail investors. I do think that comes, and that will provide an extra kick. And once we start seeing that means that we're closer towards the end of the move. But I'm still positive going forward. But I will say we've come a long way in a short period of time. And as a investor with 35% of the MJG fund exposed to precious metal related equities, I wouldn't mind for a little consolidation period here. Let's make this a longer lasting run and less of a sugar high like we saw back in 2020 or back in 2016. So that's my wish, but the market will do what the market will do.
Now, in the short term, we've had the election of Donald Trump as US president. He took office in January, and I think it'd be fair to say he's come out with all guns blazing on the things he wants to address.
Sure.
And there's been quite a few there's a lot of impact on the mining space for some of the announcements he's made, some of the executive decisions he's taken, policy decisions on rare earths, on energy security, et cetera, et cetera. What's your view of US policy and its impact on mining?
Yeah, in a general sense, I mean, it's certainly a net positive for the space. In the positive column, it's just can't underestimate the power of the sentiment boost. Trump is an extremely effective cheerleader for the causes that he champions. I will say he's probably more interested in oil and gas than mining. And you could see that with rare earths kind of haphazardly thrown into his day one executive order declaring a national energy emergency. But that said, I don't think anybody would argue that he is going to be much more pro-mining president than the previous administration. I would also say, additionally, on the permitting front, for hot button projects, look at the Ambler project, JV between Trilogy and South 32 up in Alaska, which was somewhat puzzlingly stymied during the Biden administration. I think that is certainly going ahead under Trump. You could even look at Resolution, the JV between BHP and Rio Tinto in Arizona. I should add that did not go ahead during Trump's first 4 years, but I think there's a good chance that it goes ahead in his second term. Rio has been quite vocal in recent weeks, understandably, and trying to rally the troops, because that's a phenomenal deposit that's been largely stuck in quicksand for the past 30 years.
I think Rio Tinto's CEO Jacob Straussman mentioned such on a conference call.
Yeah, and I think that makes good sense for them to talk that up loudly, and we'll see where that goes. And then for earlier stage names, like in terms of our U.S. exposure, the MJG fund's primarily invested in explorers and prospect generators, and I have heard anecdotally from a couple of our holdings that while permits didn't crawl to a stop under Biden, there were extra 3, 6, even 9-month delays in order to receive a plan of operations from the BLM or a categorical exclusion from the U.S. Forest Service in order to accelerate drill programs. So I just think we'll see a lot more activity going forward on that front. Though I should point out there are a couple negatives, I would argue, with Trump stepping in. The first is that under the Biden administration, there was significant monetary support from the federal government coming through the Department of Energy's Loan Program Office. And upwards of $30 billion were either granted or provided in cheap loans to critical mineral projects. To be fair, a lot of these were more midstream and processing. I'd say roughly only 15% of the money actually made it to miners, but some did. Key examples would be Lithium America's Thacker Pass project or Ioneer's Rhyolite Ridge, both of those in Nevada. I think it's likely that we see that program dismantled entirely. Project 2025 called for it when that came out last year. I think it's more likely than not that's followed through. And then the other point I'd add is the cost pressures, inflationary pressures that come from Trump's tariff policy. And we have later stage development projects, some of them that might have bankable feasibility studies already out, trying to get over that hump into construction. Increase the cost of steel, which is an important input into any build cost. 40% of heavy machinery comes out of China that's necessary for processing, and also the trucks and other equipment that's needed to get the ore out of the ground. Do tariffs stay at 10% with China, or do they increase to 25%? So there is uncertainty on the cost front, and that could cause trouble for some of these later stage developers. Less of an issue if you're more on the exploration side of the equation.
Now, Trump said that he wants to expedite permitting and wants to speed up permitting times, which is the bane of the mining sector and mining developers.
Sure.
At the same time, he's also cutting staff. So that sets up quite a quandary. You want to accelerate permitting, but there's fewer hands to actually review the documentation or do whatever it is the permitting agencies do.
That's right. I mean, I would say on the broader permitting front, the golden goose, so to speak, is NEPA. That's the National Environmental Policy Act. And that has stymied a lot of larger scale projects, not just in the mining space, but really infrastructure and broader than that from going forward. I do think Trump is going to push aggressively for NEPA reform. I think if that reform happened, it would be really positive for the space, both in the near term and going forward. The problem there is, to my understanding, that takes congressional approval. And the Republicans have extremely narrow margins in the House of Representatives. I think the narrowest of margins going all the way back to 1931. So whether there will actually be congressional movement on NEPA reform, I would put the odds at less than 50-50, just because of all the other priorities, and again, that very, very narrow majority that we see in the House.
Now, Matt, you mentioned the inflation impacts on inputs due to China tariffs, but what about China's response to those tariffs? For example, they announced that export bans effectively on certain critical metals such as tungsten, and suddenly tungsten is a trending theme because tungsten is used in all kinds of different industries, but has very specific applications in military. It's a hardening agent, so that's what you put on the tip of your armor-penetrating shells, and conversely, that's what you use to build your armor to stop those shells. We've seen there's a couple of tungsten companies or juniors here, one of which is Almonte Resources. I interviewed their CEO, Louis Black, a couple of weeks ago. For a relatively small, unknown company, that video has gone viral with over 35,000 views. Incredible. So where am I going with this? There are going to be impacts on this. China's starting to play hardball, I think you could say, if it expands its bans onto other things, such as mining machinery or copper even.
Sure.
Things get serious very quickly.
Yeah, I think you really have to look at each of these metals on a case-by-case basis, and we could talk for an hour about it. But I guess a quick tour de force. I'm a little less worried about tungsten supply for the Western world. You mentioned Almonte. They have mines in Portugal. They have a couple later stage development projects in Spain. They have a mine in South Korea that's now ramping up. And also Biden did put in some smart policy earlier on in 2024, kind of anticipating a potential tungsten ban. So that's not a metal that I'd be particularly worried about from the United States security perspective. Antimony is another metal where we've seen a flat-out ban as of late last year. Was able to sit down with the U.S. Antimony at this conference, and that was a really interesting meeting. They have a very strategic smelter in Montana, as well as a smelter in Mexico as well. I think there are some opportunities on the mining front in terms of antimony, and we're seeing quite a few juniors scramble. The antimony is often a byproduct with gold production, so we're starting to see antimony be talked up by groups like Southern Cross. We're just about to see a spin out from Liberty Gold and kind of rebranding their Gold Strike project more as an antimony story. For a lot of these projects, the antimony isn't the primary driver of the economics, but I do think it's a nice card to slip out there and potentially on a case-by-case basis can help these projects get permitted more quickly. And two other metals of note would be gallium and germanium. I think there are relatively quick fixes if there's the political will and the money to make that happen. Gallium is a byproduct of alumina processing. Rio has massive operations up in Quebec. I think for $50 or $100 million and a real push from either the U.S. or Canadian government, they could get a gallium circuit up relatively quickly. Germanium, there's heaps of it at Teck's Red Dog deposit in Alaska that's sent down to the Trail smelter in BC. I believe they're recovering some of that germanium, but again, with some attention and some investment, I think we could, within a couple of years, increase supplies of those metals to the point where they're less of a concern from a U.S. perspective. Rare earths are a bit of a different story, though.
Okay, let's change tack a bit. Let's talk gold companies. We're in the midst of the 2024 financial results reporting season. It's been a big mixed bag. Costs continue to go up with a couple of exceptions. Notably last night, Newmont put out its results, 5% all-in sustaining cost reduction, incredible results. They're chucking off cash like there's no tomorrow. They paid out shareholder returns of over more than $2 billion last year, evenly split more or less between share buybacks and dividends. Is this the moment in time when excitement and greed amongst the broader investor space starts to come back and look at gold and gold companies again?
Sadly, I don't think it quite is, at least as we look through the lens of Newmont. Good quarter, no question, but we have to also note a couple facts. The first is that their profits were buttressed by non-recurring items. They've just engaged in 6 major asset sales, and absolute hat tip to the company. They were expecting and guided to the market roughly $2 billion in proceeds that they were expecting from their non-core asset sales. They ended up getting closer to $4.3 billion. So that was a very strong outcome for the company, but we're not going to see those asset sales reflecting in earnings results going forward. I'd also say that the assets that were sold are some of their higher cost assets. So that's going to naturally, with those excluded from the picture, that's naturally going to help on the all-in sustaining cost front. So I would argue that the goalposts have kind of been reset, and it's really going to be for Newmont to prove to the market over the next 1, 2, 4 quarters that the current baseline that we saw today is sustainable. And ultimately, there's going to be some cost creep. Inflation continues to remain an issue, but they need to prove to the market that the increases in the price of gold that we see are not going to be largely offset by increases on the all-in sustaining cost front. And I think it's too early to say based off of the earnings that we saw yesterday.
Okay. Another aspect that comes out of this, as you mentioned, Newmont recently completed its divestment of 6 mines and $4.3 billion. People in the sector think that has overhung M&A activity for the past year or so. There were dozens of companies involved in biddings for those assets, so presumably while they were bidding for Newmont assets, they weren't perhaps being active in other M&A activities. So now that the Newmont assets are gone, there's obviously dozens of companies that weren't successful. Presumably they'll be looking for other assets. So is it gold company Tinder time?
I think it is, honestly. I think I firmly agree with that sentiment. Look, for each of these 6 asset sales, we're talking 20, 30, 40. I heard in one case upwards of 50 groups in the data room examining the specific opportunities there. And so, mining companies are constrained on the due diligence front. Before you pull the trigger on a multi-$100-million acquisition, you're going to have to make sure to check out that opportunity top to bottom. Now the skilled personnel that we're evaluating the Newmont assets can look elsewhere. So I think that does take a pretty significant overhang off of the space in terms of gold specific M&A. I would also argue that the fact that gold seems nowadays to be one of the few metals that actually you can transact with Chinese parties. Really across the board, many different metals are being thrown into that broader strategic mineral or critical mineral basket. But gold has so far been able to escape the gaze of Western governments that have beat down deals with other metals. And we've seen Zijin in particular be extremely active over the past 12 to 18 months, taking Rosabel off the hands of IAMGOLD, Akyem off the hands of Newmont, Larina off the hands of Pan American Silver. And not quite M&A, but also interesting phenomenon. We've seen Zijin and the Lundin family team up on a couple gold-specific projects in Western Africa. That started last year, where they both made a joint investment into Montage Gold. And then just a few weeks back, we saw the same into predictive mining in their Bankan project in Guinea. And I think hold all else equal, but change the target commodity for those projects from gold to copper, or really any other metal that could feasibly fall into the critical minerals bucket, those deals would not be happening. So I think all of these forces bode well for continued M&A, and not to mention just the sheer volume of opportunities. Like 45 to 50% of juniors on the TSXV are gold focused, so there are plenty of assets to be picked over. So I think this trend continues.
I think it's interesting your comment about, should we say, Canadian interference in deal making.
Sure.
And there's talk or possibility of Barrick redomiciling from Canada to the USA to, obviously it's making a big push to get into the copper space or increase its exposure to copper. It's worked, co-invested heavily with Chinese companies in the past, presumably it wants to continue to do so, and redomiciling in the USA may mean it doesn't get any potential Canadian government interference for that. What do you make of Barrick potentially redomiciling?
Yeah, it's interesting. I think you touched on one of the aspects. Another news that's hit the headlines within the past couple weeks is Trump's decision to go much more lightly on corruption globally and bribery and paying off officials. So I'm not saying that has anything to do with Barrick's decision, but that's another aspect that could be helpful. And I also think Barrick's been really stuck in the mud here for really since Bristow took over. And so this is maybe an opportunity for them to reshuffle the deck, kind of get a fresh start, also generate some fanfare about returning to America. So we'll see if that actually comes to pass. But I think there's probably a few different factors that are going into that decision.
It's looking at the market capitalizations of the top gold producers now, and Barrick has not just slidden into third place, it's way into third place. Newmont Corporation, let's say $53 billion. Agnico Eagle Mines, very much consolidated, just behind, $49 billion. Barrick languishing in third spot at $33 billion.
Yeah, they need a reset. And kudos to Agnico Eagle. What an incredible run that they've gone on over the past couple years, really showing their operational excellence, and also that sticking to core geographies, core styles of mineralization that well bodes well. They've been very strategic and I think disciplined on the M&A front, and that's borne out in their share price outperformance relative to their larger peers.
Now, we started talking about potential gold M&A. So what makes a smart deal?
So I go through a few factors. I think first principle is that upwards of 80% of deals that you see are value destructive for the acquirer. So investors need to keep that in mind and always be quite skeptical, I think, especially if you own shares of a company that's making an acquisition. There's really a list of 10 different questions that I ask myself when evaluating a deal. I don't think I'll be able to rattle all 10 off the top of my head. But one example is, are there operational synergies between the assets in questions? Does the management team of the acquirer have deep experience in the region or the district of the asset that they're acquiring? Is the asset that they're acquiring in the same time zone as the existing operations? Is the asset that they're acquiring relatively near where management lives or where the company's HQ is? Does the asset that's being acquired share characteristics, whether geologically or in terms of the mining method, with what the company's doing already? Does the metal that is being acquired make coherent sense with what the company's already producing? Does the acquirer have the financial bandwidth to actually material push the project forward? Is it a related party transaction? That is a key question to ask. And then, of course, was the price right, and was the price fair from an acquirer's perspective? So that's kind of most of the questions that I ask myself when looking at a deal. I mean, a couple examples of deals, kind of poster children, you could say, of how to do a deal right. The big one would be Alamos Gold, taking over Argonaut and their Magino mine. That really checks all the boxes. The assets are right next to each other, same style of mineralization, obvious operational synergies in terms of increased production profile, extended mine life, using the Magino's tailings facility for island instead of having to re-permit on the tailings front. Deep expertise of management in that particular region. So that checks all the boxes. Another example from a little earlier on would be Lundin Mining's takeover of 70% of Caserones. This was back in 2023. This is in Chile. Lundin Group has deep experience in Chile, in the Vicuña district specifically, where they have a very strong presence. Right metal mix in terms of Lundin's existing production profile. Caserones is only 150 kilometers or so from Candelaria, which in that part of the world is just a stone's throw. And Lundin has the financial capacity to actually give Caserones the tender love and care that it wasn't getting from the previous owner. So those are a couple deals that stick out from the past few years, where it's like all of these boxes were really checked.
Well, hopefully it's going to be an interesting year or two on the M&A front. One final thing, Matt, you sort of tend to focus on juniors. Are higher metals prices making it easier for companies to finance, for junior companies to finance? Is more money becoming available for them?
Not yet. Yeah, I would say not yet. We've seen quite a few financings announced in the past few weeks, but that's also largely seasonal factors. I included a chart in the most recent MJG investor letter, and it showed that the total amount raised by TSXV listed mining issuers is still off 80% from where it was back in 2010. And there's been, from what I'm seeing, there's not been a noticeable uplift. I think things can change pretty quickly, and we've just had the TSXV break out of a pretty significant technical level. So again, if we talk in a few months, it could be a different story. But I'm not seeing oodles of outside capital flooding into the space as of yet. Though I am seeing the share prices of certain companies that have upcoming catalysts, solid projects, solid management teams responding pretty well. So we're in the early stages, but we're not there yet where we can say we're out of the woods from this dearth of capital.
Well, hopefully better days aren't too far into the future.
One can hope, yep.
Exactly. Matt Geiger, thank you very much for joining us today.
Thank you. Good being with you, Paul.
And we have more to come from the 2025 Mines and Money Conference in Miami and Florida, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.